Warren Buffett never built Tesla, Facebook, Google, or Microsoft, and he has openly admitted that missing some of the greatest technology investments of modern history was one of his biggest mistakes. Yet, despite missing those opportunities, he still became one of the wealthiest individuals on the planet, and that single fact alone forces us to question a very popular belief about wealth creation, which is the idea that to become extremely rich, you must either invent revolutionary technology or invest early in flashy innovation, because Buffett's journey suggests something very different, something far less glamorous and far more uncomfortable for the human ego. And that uncomfortable truth is the underestimated power of boring businesses, the kind of businesses most people ignore, underestimate, or actively avoid because they do not sound impressive, do not create headlines, and do not make anyone look smart at a dinner party, yet they quietly generate massive, reliable, compounding wealth over long periods of time. When we think about successful businesses, our minds automatically jump to iconic brands, visionary founders, and dramatic innovation stories, but we rarely stop to analyze the businesses that function silently in the background of everyday life. The businesses that do not chase attention, but instead serve necessity. And this is exactly where Buffett shifted his mindset early on by putting his ego aside and focusing on what actually works rather than what looks exciting. Boring businesses are not boring because they are ineffective. They are boring because they are predictable, repetitive, and deeply tied to human behavior that does not change easily, and predictability in business is far more valuable than excitement. Consider industries like self-storage facilities, waste management, parking lots, commercial cleaning, pest control, portable toilet rentals, and industrial warehousing. None of these businesses sound revolutionary. None of them promise to change the world, and none of them attract young founders dreaming of fame, yet these businesses exist in almost every city, generate steady cash flows, and often operate profitably for decades with relatively simple operational structures. The reason they survive and thrive is because they are built around basic human needs rather than trends, and trends are temporary while needs are permanent. People will always produce waste, always need storage, always need sanitation, always need transportation, and always need physical space to operate, and as long as these needs exist, the businesses serving them will continue to earn money regardless of market hype or technological fashion. This is why Buffett and investors like him prioritize businesses with high utility rather than high novelty, because utility creates repeat demand without persuasion. One of the best real-life examples of this philosophy is Kohler Co, a company many people have heard of, but very few people truly understand, and even fewer people admire. Yet the Kohler family built a multi-billion-dollar fortune by manufacturing toilets, sinks, and plumbing fixtures, products that are essential, unexciting, and completely taken for granted. Kohler did not grow by reinventing bathrooms every year or creating viral marketing campaigns. It grew by focusing on quality, durability, distribution, and long-term relationships with builders and governments, and over decades this boring focus compounded into enormous wealth. Another example is 3M, a company often overlooked because its products are mundane, such as sandpaper, tape, adhesives, and office supplies, yet these simple products are embedded into thousands of industries, making them indispensable. And because they are used repeatedly and replaced regularly, they generate recurring revenue that compounds quietly year after year. This is the pattern boring businesses follow. They do not rely on consumer excitement. They rely on routine, and routine is incredibly powerful. When demand is routine, forecasting becomes easier, pricing becomes more stable, and long-term planning becomes possible, which reduces risk, and reduced risk allows capital to stay invested longer, and time is the most important ingredient in compounding. A useful way to understand boring businesses is through a simple four-filter framework that helps identify why they work so well. First, they do not bring recognition or social status to the owner. Second, they are difficult to feel emotionally motivated about. Third, their demand and pricing are easy to predict. And fourth, they are highly likely to exist 10 or even 20 years from now, and if a business passes all four filters, it is often a strong candidate for long-term wealth creation. Most people fail the first two filters immediately because their ego demands validation, admiration, and excitement, and boring businesses offer none of that, which is precisely why competition remains low and returns remain attractive. Take self-storage facilities as a real-world example. They are cheap to maintain once built. They require minimal staff, they hold no inventory, and they serve a growing demand because modern societies continuously accumulate more possessions, and as urban living spaces shrink, the need for storage increases rather than decreases. From a customer's perspective, self-storage is convenient and affordable, and from a business perspective, it offers stable occupancy rates, inflation-adjusted pricing, and long asset life. And once the initial capital investment is recovered, the ongoing cash flow can be reinvested into building additional facilities, creating a compounding loop that strengthens itself over time without increasing operational complexity. This compounding nature is what separates boring businesses from attention-driven or service-heavy models like marketing agencies or trend-based startups, where revenue depends heavily on constant effort, client churn is high, and past work rarely continues generating value on its own. In many service businesses, once the work is done, the value disappears, forcing the business to continuously hunt for new opportunities just to stay afloat, which limits scalability and compounds stress rather than wealth. Boring businesses, on the other hand, are asset-based or contract-based, meaning yesterday's work continues paying tomorrow, and this creates leverage not through technology but through time. Another important advantage of boring businesses is their relationship with regulation, which most entrepreneurs view as an obstacle, but in reality, regulation often acts as a protective moat. Industries like waste management, utilities, and infrastructure require permits, compliance, and long-term planning, making it difficult for new competitors to enter, which protects existing players and stabilizes profits. Buffett understood that predictable regulation combined with predictable demand creates a rare environment where capital can compound safely for decades. The irony is that most people intellectually understand this logic, yet emotionally reject it because boring businesses do not satisfy the desire to feel special or innovative. We are conditioned to admire extraordinary stories of disruption and genius, while quietly ignoring the businesses that actually pay the bills of society every single day. This cultural bias leads people to gamble on speculative ideas rather than commit to proven models that require patience and humility. The uncomfortable reality is that boring businesses often represent the safest path to long-term wealth, but they demand discipline, consistency, and the willingness to remain invisible, and for most people, invisibility feels worse than failure, which is why so many chase excitement and abandon stability even when stability is the smarter choice. What makes this entire idea even more powerful is that boring businesses do not depend on perfect timing. In flashy industries, timing is everything. Enter too early and the market is not ready. Enter too late and competition destroys margins. But boring businesses operate on time-tested demand. The timing window is wide because the need already exists. A waste management company does not need to predict consumer trends. A parking lot owner does not worry about changing tastes. A self-storage operator does not fear the next app replacing physical space. These businesses survive recessions, inflation cycles, and even technological shifts because they are tied to physical reality. People still live somewhere. People still move houses. People still throw trash. People still need sanitation. That physical layer of the economy changes very slowly, and slow change is exactly what long-term capital prefers. This is why Buffett often says that the best businesses are those that an idiot can run, because sooner or later an idiot will. Simplicity is not a weakness. Simplicity is a defense. When operations are simple, mistakes are fewer, costs are controlled, and decision-making improves. Compare this with complex businesses where one wrong strategic move can destroy years of progress. Simpler systems break less often, and when they break, they are easier to fix. Another real-life example of this principle is Waste Management Inc., one of the largest waste disposal companies in the world. No one dreams of owning a garbage company, yet it generates billions in revenue annually. Its competitive advantage comes from landfill ownership, long-term municipal contracts, and regulatory barriers. Once a city signs a waste contract, it rarely changes providers unless something goes seriously wrong. This creates extremely sticky revenue. The trucks may look ordinary, but the business model is incredibly durable. The same logic applies to businesses like Rollins Inc., the parent company of Orkin Pest Control. Pest control is not glamorous, but pests never disappear. Homes, restaurants, warehouses, and hospitals require regular service. Customers sign recurring contracts. Revenue repeats, costs remain manageable. Over decades, this repetition compounds into massive scale. What looks small at the beginning becomes enormous with time. This is the snowball effect Buffett talks about. Not explosive growth, but steady accumulation. One layer at a time, one acquisition at a time, one reinvestment cycle after another. The snowball does not need speed, it needs distance. Distance comes from survival, and boring businesses survive longer than exciting ones. Another misunderstood element is pride. Many people reject boring businesses because they want their success to be visible. They want admiration before wealth, but boring businesses flip the order. They generate wealth first, visibility later, if ever. Many of the richest families in the world are unknown to the public because they own logistics companies, manufacturing firms, distribution networks, or infrastructure assets. They do not appear on magazine covers, but they appear on balance sheets. This invisibility is actually an advantage. It keeps expectations low, pressure manageable, and focus intact. Buffett himself avoided media hype for decades while quietly compounding capital through insurance, railroads, consumer goods, and utilities. Berkshire Hathaway did not grow by chasing trends. It grew by acquiring boring, cash-generating businesses and letting them operate independently. Insurance float-funded investments. Investments funded acquisitions. Acquisitions funded more float. This closed loop is boring on the surface, but brilliant underneath. It is also important to understand that boring does not mean small. Boring businesses scale differently. They scale horizontally rather than vertically. Instead of inventing something new, they replicate what already works. Another storage facility, another parking structure, another service route, another franchise location. Each unit may look identical, but together they form a powerful network. This replication reduces risk because the model is already proven. Franchises like McDonald's are technically boring businesses. Burgers are not innovative. Operations are standardized. Demand is predictable, yet the scale is global. The same applies to car washes, laundromats, and roadside assistance services. Individually, each unit is unimpressive. Collectively, they become machines of cash flow. This is where many aspiring entrepreneurs get confused. They search for uniqueness when they should search for reliability. Uniqueness attracts attention. Reliability attracts money. Attention fades. Money compounds. Another factor people underestimate is pricing power through inconvenience. Many boring businesses deal with problems people do not want to think about. Trash, pests, toilets, storage clutter. Customers are willing to pay to avoid these inconveniences. They do not negotiate aggressively because the service removes mental discomfort. This gives boring businesses quiet pricing power. Small annual price increases go unnoticed. Inflation adjustments become accepted. Over long periods, these small increases dramatically improve margins. This is how wealth is built quietly, not through sudden breakthroughs, but through incremental advantages that stack over time. When you zoom out far enough, the pattern becomes obvious. The economy is built on boring things. The exciting layer sits on top of it, but the foundation is boring. Technology companies may come and go, but physical infrastructure remains. This does not mean innovation is bad. It means innovation is risky. Buffett did not avoid technology because he hated it. He avoided it because he could not predict it. He stayed within his circle of competence. Predictability beats intelligence when time horizons are long. This brings us back to the uncomfortable question that exposes our real motivations. If someone guaranteed you $1 million a year after 10 years of running a portable toilet business, most people would still hesitate. Not because the math is bad, but because the ego is uncomfortable. The work feels beneath the identity people want to project. Yet money does not care about identity. Money responds to value delivered consistently. The market rewards usefulness, not ego. This is why boring businesses continue to outperform expectations while exciting ideas disappoint. The real skill is not finding the next big thing. The real skill is committing to something unexciting long enough for compounding to do its work. Once you truly understand this, your perception of opportunity changes. You stop asking what sounds impressive and start asking what will still exist 10 years from now. You stop chasing trends and start building systems. You stop seeking validation and start seeking durability. And when you reach that point, you realize that boring businesses are not boring at all. They are simply honest. Honest about how wealth is actually built. Honest about patience. Honest about time. So now think carefully. Look around your city. Look at the businesses that never close, never trend, and never disappear. Which of them quietly prints money every single day while everyone else is distracted? And more importantly, if the path to long-term wealth is this clear, what is stopping you from choosing it? Drop your thoughts in the comments because the answer is rarely about money, and if you want to keep understanding how wealth actually compounds in the real world, staying connected here might quietly be one of the smartest long-term decisions you make.